What do current equity valuations and bond yields potentially mean for returns in the coming decade? Today, Rob Arnott, chairman of Research Affiliates, gets out his crystal ball and shares his thoughts. If you've heard Rob on prior episodes of the podcast, you'll know he's not shy and doesn't pull any punches. More importantly, he also shares some great ideas for retirement plans on how they can design investment menus by understanding where we are today and looking forward at potentially what's coming in the next decade. If you like what you heard today, Rob has 3 prior appearances on the podcasts that probably would make sense to check out. Links will be available in the podcast episode notes. Before we get started today, I'm always looking for new ideas for podcast guests, topics, or any questions you might be looking for answers to. If you have something on your mind that would benefit retirement plan sponsors or those who partner with them, send me an email to feedback@401kfridays.com. We'll take it from there. That's it. I hope you enjoy my conversation with Rob. Well, Rob, welcome back to the podcast. I think this is our 4th time doing this, and no pressure today, but prior episodes have always been awesome, so I can't wait to hear what you have to say today.
Well, thank you very much. It's a privilege to join you again, and thank you for the invitation.
Well, as we sit here in basically March of 2021, we're getting closer to herd immunity. We seem to be on the cusp of another major round of stimulus, and the markets are basically soaring, kind of at or near all-time highs. So all's good?
Well, yes and no. The stimulus, people use the word stimulus with the tacit implication that printing money and spending money that we don't have, deficit spending, stimulates something. Well, what it does is it stimulates asset bubbles. It does not stimulate the macroeconomy. It moves consumption and investment forward or back in time. So if you engage in fiscal stimulus, sending checks to people, it increases near-term consumption at the expense of future consumption, because ultimately any government spending today has to be paid out of taxes today or tomorrow. So taking money out of productive economy activities now or in the future to subsidize activities that are deemed useful or necessary today. And so what I like to think of stimulus as redistribution, both from one class of citizenry to another, and it's not always from the haves to the have-nots. Oh my goodness, no. Or from the future to the present. Either way, it doesn't really stimulate in ways that bolster growth of the macroeconomy on a long-term basis. So I'm disturbed by the nature and the magnitude of the stimulus that's being contemplated. We have had soaring markets, and until recently, tumbling interest rates, which is another way of saying soaring bond markets. But the economy has done nothing more than bounce back towards levels pre-COVID. So yes, we're getting close to herd immunity. So why are we sending checks without vetting whether the recipients are gainfully employed and don't need the money, or are out of work because of COVID and can use the help? If you assume that 80% of the recipients don't need the money, then the stimulus is just redistribution. It's not healthy. And if you wind up paying people more than they could have made on the job, that gets even worse because it creates an adverse incentive to not produce goods and services that people want. The herd immunity is very real. We've had 30 million cases in the US. That's just the known cases. The actual number is probably 3 to 5 times that. So call it 100 to 150 million people. There are some knowledgeable observers who quietly speculate that over half of the US population has already had COVID. Wow. And if you add to that half of the population having the vaccine by the end of April, then you're down to about 1/4 of the population that hasn't had COVID and hasn't had the vaccine. That's pretty much herd immunity. So we can reopen the economy. We don't have to wait because cases are already down 70% from 5 weeks ago.
As you're saying all this, and I think as we've been talking to companies and clients that we work with, we've been striking kind of a cautious tone in terms of where we go from here. And I think a lot of the head scratching on the other end of these, conversations has been, well, hold on, Rick, I don't get what you're saying here. It's, we've come through a really tough time and, all the stuff you just talked about and all the great news here. So why do we need to be cautious, or why should we be, maybe not so optimistic on where the markets go from here? So I don't know, Rob, what are your thoughts on that? Or I guess first off, do you agree we should be cautious? I'll start there. And how would you kind of explain that to someone making decisions about investments in a retirement plan?
Well, the old cliche is buy on the rumor, sell on the news. The next round of stimulus is coming, whether we need it or not. Fiscal stimulus makes its way into the capital markets by first going to people or the bureaucracy or whatever, and then from there into the capital markets if it's not needed for immediate consumption. And monetary stimulus goes directly into the markets and from the markets into the macroeconomy. Both wind up making their way through the capital markets at some stage. And so they wind up being very stimulative to the capital markets. Now, as we look at the upcoming stimulus, the question is, why on earth would you want to be cautious? And the short answer is, once the stimulus is out there, it's had its effect. And the market looks ahead and anticipates. So market strength in recent weeks has been based largely on an expectation of, okay, there's another $2 trillion stimulus coming. Much of it isn't needed. And therefore, much of it will make its way into the capital markets, pushing markets higher. So therefore, let's bid it up in anticipation. So buy on the rumor, sell on the news. Once the stimulus is in place, has been passed and is beginning to make its way into the economy, may be a very good time to move towards a risk-off posture. The other thing worth noting is that when stimulus isn't needed and is taking place anyway, at some stage it stops working. We've seen that again and again in history, where countries take their national debt to 100% of GDP or more or much more, and inevitably it slows economic growth and it has severe consequences down the road. So at some stage, stimulus actually has a counterproductive impact on future economic growth. And that's something that most economists wouldn't dispute. They would argue that the surge in the economy is urgently needed now. And if the consequence is slower growth in the future, that's an okay trade-off. Comparatively few will say that stimulus stimulates now and later. But all of this would suggest that whether the stimulus stops or simply stops working, the 2020s are likely to be a very tough decade for investors in U.S. stocks and bonds. Emphasis on U.S. The U.S. is at a Shiller PE ratio of 34 times the 10-year average earnings. That is near record territory. The all-time high was 44 times at the peak of the tech bubble. Price to sales ratio is at an all-time high. Market capitalization to GDP is at an all-time high. In both cases, higher even than the peak of the tech bubble. So with markets this expensive, the markets are priced to give you a lousy future return. And with bond yields below the expected rate of inflation, bonds are priced to give you a lousy rate of return. Does that mean all opportunities are bad? No. Non-U.S. stocks, EFA is priced to give you about a 5% return, 3% real. Not so bad. Emerging markets are priced to give you about an 8% return, 6% real. Not so bad. And emerging markets debt is priced to give you 2 to 3% real over and above inflation, net of the historically normal rates of default. Value also is at unprecedented relative cheapness compared with growth stocks on a global basis, cheaper even than at the peak of the tech bubble. So this is a really interesting time to be a value investor and an investor diversifying outside of the U.S. Unfortunately, most investors chase what's done well recently. That's why we find most investors buy high and sell low.
Yeah, and I know you're a value guy, and so if I butcher this, just please correct me. But I heard this again recently the other day, which is why it's kind of top of mind. Where I think it was Benjamin Graham who said, in the short term, the markets are a voting machine, and in the long term, the market is a weighing machine. Did I get that right?
That has been attributed to Ben Graham. In point of fact, the source of that is not entirely known. Jason Zweig at the Wall Street Journal wrote a biography on Ben Graham and couldn't find the quote in the archives. So maybe it was concocted and attributed to Ben Graham, but boy, it resonates. It's spot on.
Kind of like Abraham Lincoln always gets a lot of quotes attributed to him somehow. So anyways.
And Einstein. Einstein's said about 1/4 of the things he's supposed to have said. Well, if you want to sound intelligent, say something and attribute it to Einstein, and then you've automatically put yourself in the same league with him.
There you go. And in the value world, attribute it to Benjamin Graham.
Absolutely.
But I guess pulling on that string for a second, it seems like when you and I get together, we always talk about the death of something. And I think the last time we chatted, the death of value was what was very top of mind. And just for context, last time you and I chatted was January 2020, really before the pandemic had any real position in anybody's thoughts or mind. And so just kind of going back to that, as we sit here today, what do you think about some of those statements about the death of value? How would you characterize that or frame that based on maybe what's transpired over the last year or two?
Well, as Ben Graham famously said, when value seems to be dead, it's time to buy value. No, he didn't say that.
I was going to say
value has fallen to relative valuation levels that haven't been seen even at the peak of the tech bubble. The COVID meltdown was particularly brutal to value for all the obvious reasons. The growth stocks were the leaders in creating the technology that allowed us all to weather the pandemic. We could have our daily shipments from Amazon at home. We could binge watch on Netflix, you name it. And so these companies were stark beneficiaries of both COVID and a post-COVID world in which our behaviors will have changed. Value, the other side of the spectrum, was compromised by speculation that countless value companies would go bust. Now, the U.S. has about 30 million companies, of which 3,500 are publicly traded. So a very small fraction are publicly traded. Of the 30 million, there's no question millions have gone out of business. We don't know how many millions, but millions have gone out of business. Of publicly traded value companies, shockingly few have gone out of business or appear on the ropes and likely to go out of business. So the rebound in value since September seems to be based on the marketplace realizing, hey, these companies aren't going to go bust in the numbers that the current pricing suggests. The spread in valuation between growth and value stocks on price to book value was 10-1 at the peak of the tech bubble. It was 12-1 at the end of August, 20% cheaper for value relative to growth than it was at the peak of the tech bubble. So of course the snapback has been impressive, but it's only taken us from 100th percentile, cheapest ever, to 98th percentile. Just going from 98th percentile to middle of the cheapest decile ever, 95th percentile, would involve over 2,000 basis points of outperformance. So my goodness, the opportunity here is huge. Two things that were speculated to be dead last year were value investing and diversification. I've said this before during your podcast, but diversification is a regret maximizing strategy. If you're in a roaring bull market, you regret every penny you've got invested in diversification away from the market that's soaring. And when that market goes flat for a long period of time or goes into a secular bear market, you regret every penny that you don't have in diversifiers. We saw a transition from the 90s to the 2000s from a secular bull market to a stupendous secular bull market to a secular bear market. I think we're going to see a transition from a spectacular bull market in the 2010s to a sideways market at best and perhaps a secular bear market in the 2020s. Most investors are lightening up on their exposure to value and on their exposure to diversification. That's a terrible mistake, but it goes hand in hand with investing with your eye in the rearview mirror and asking what's done best for me lately. Whatever's done best for me lately, I want more of that, even though in all likelihood, anything that's overpriced got there by performing brilliantly. Anything that's newly cheap, any new bargain got there by inflicting pain and losses. To be a successful long-term investor, you have to be willing to buy what's inflicted pain and losses and to top up what is newly cheap.
Yeah, and I think that concept, that idea, I think a lot of people can easily rattle off, hey, buy low, sell high. I mean, I think that's something that some people have obviously had beaten into their heads.
Everyone says it, hardly anyone does it.
Yeah, exactly. And what I'll point to as well is just in the world of retirement plan oversight and fiduciary plan reviews and things like that, it's, hey, as you're going through these reports, everybody wants to see, we've got a lot of green bubbles, we've got high scores, we've got whatever. And a lot of times as you're looking through all of that, to your point, kind of looking through the rearview mirror, it's tough to say, hey, you know what? This target date fund was one of the better performing target date funds out there because of their growth tilt or their large cap focus. And maybe you don't feel so good about how yours did, or maybe you feel really good that you're in that one that had that, that kind of had the winning combination over the last few years, or the last, during the pandemic, whatever it is. So I'm leading my long-winded statement here, leading up to a question is, I think now more than ever is the time for people to be a little courageous and to be a little forward thinking. So, I mean, what you're saying resonates and makes a ton of sense, but how do you kind of help somebody say, okay, well, we shouldn't look at this one that's done really well. We should maybe look at this one that's hasn't done as well, but is more diversified or is more, I don't know, maybe like, how do you kind of walk somebody through that in a way that they can understand versus, yeah, this one's got a lot of green next to it, but this one doesn't have as much green, but you're telling me that's the one, huh?
Well, a few quick observations. We have interactive websites for Asset Allocation Interactive and Smart Beta Interactive. If you Google either of those terms, the first non-ad will take you straight to our interactive websites for looking at asset allocation and looking at smart beta strategies. Now, the point of those interactive tools is to get people to shift their focus from looking at past returns to looking at projected future returns. Long-term future returns are easier to forecast than most people realize. You've got the yield, you've got growth in income, which for fixed income by definition is zero, it's fixed. For stocks tends to be inflation plus a little bit of the real growth in the macroeconomy. Let's call it CPI plus 1 or 2%. For high yield, it's negative. There are some defaults. But you can know from history what the normal pattern of long-term growth in income is. Add the income to the long-term growth in income, and you have the sustainable long-term return for the asset class. Simple, very simple. And in fact, that produces a forecast that is rarely wrong by more than 2% on a 10-year annualized basis. Wow, that's a pretty good forecast. Now you can do this with smart beta strategies. You can ask the question, is value newly cheap? And is it priced to give you great forward-looking returns? The third part of the return is the possibility of mean reversion. And for that, we like to make the assumption that we don't know if this is a new normal and the value growth spread will be as wide as it is now forever, or if we're going to mean revert back to historic norms. So let's make a simplifying assumption and assume that we go halfway back to historic norms. Now, if you do that, you get a shockingly good forecast for long-term 5 to 10-year returns. Investing on that basis can make a whole lot of sense. So the purpose of those interactive websites is to get people to recognize that past returns do not predict future returns, and that the source of the past return matters. If value had underperformed ferociously in the last 4 years because value companies were failing left and right, all right, the underperformance is justified by the fundamentals. If they've underperformed because they've gotten cheaper relative to growth stocks, then that's a different story entirely. That means you've got a newly created bargain and you'd be nuts to turn your back on it. That means buying something that looks disappointing. Now, what I've been very proud of is that our RAFI and RAE strategies, the value-oriented strategies that we're known for, have beat the value indexes soundly. And they tend to win whether value is winning or losing. When value is winning, we beat the market and we beat value. When value is losing, we beat value and maybe not the market. And that's okay, because if an investor wants a toehold in value, having a value strategy that beats value pretty relentlessly is awfully interesting. And likewise, our diversification strategies, like the all asset and all asset, all authority funds, have done well relative to diversifying asset classes, not relative to the S&P, not relative to 60-40. But come into a decade where 60-40 lags and the diversifiers win, if we beat the diversifiers, as we have pretty reliably in the past, then we beat diversifiers that are beating 60-40. And that diversification strategy winds up being a big win for investors. So I'm pretty proud of the results we've delivered, measured against relevant benchmarks, measured against comparators that are in the same category.
So I'm going to pose a question here, and the background of which is, I think if you look at most 401k plans, and if you just kind of roll them up to a very simple statement, I think most 401k or workplace retirement plans are essentially a 60-40 portfolio, give or take a little bit. So without getting
many
into,
of them don't even offer diversifiers at all.
You're beating me to the punch here. So if I was going to give you the pen and say, hey, Rob, I'm interested in looking out in terms of what's coming and what the next decade potentially has to offer, and we're willing to think differently about the way that we design the investments in our 401k plan, without getting into specific names of funds or things like that, how would that look if I was looking forward versus maybe looking backwards in terms of investment asset classes or menu design?
Back in 2001, I was invited to keynote at the SEBA conference. SEBA is a group of the largest pension sponsors in the nation. And my remarks center on past is not prologue. I suggested that the quarter century that had just passed was a quarter century of rising importance of pensions in the capital markets, and that the coming quarter century would begin to see the pension promise compromised by overpromising and under-delivering. And I think we're going to start seeing that in a very big way in the coming decade. Forward-looking return expectations for pensions tend to be centered on about 7%, and the likelihood of earning 7% with a conventional mix is very, very remote. Bond yields are negative relative to inflation. Stocks are priced to give you roughly zero relative to inflation, maybe 2 or 3% above inflation. If they don't, mean revert towards historic valuations. But if they do, then you could even see negative returns. And so what we're looking at is forward-looking returns for a classic balanced portfolio, call it around 2%, around zero real, and forward-looking expectations of around 7%. My comment in 2001 was, you guys are all moving from DB to DC thinking that immunizes you from litigation. We're in a country where you can sue for anything. And the risk of litigation in 401k centers on you're using examples to show people how their wealth will grow if they earn 8%. And at the time, the Shiller PE ratio was over 40, and the bond yield was about 4%. And I said, you're not going to get 7% out of this. And of course, you didn't. The 2000s were a dreadful time for 60-40. And I think the 2020s are going to rhyme with the 2000s. It's likely to be difficult. So now we're in an environment where most 401k platforms offer conventional vehicles. Basically, the defense is, hey, we offered the same thing as everybody else. Yeah, but you didn't offer me anything that performed really well. And those things were available. So offering a richer toolkit is probably the best defense that any defined contribution sponsor can possibly have against criticism from their employees, their investors, who say, hey, you only gave me 60-40, and 60-40 was awful for 10 years, and I can't afford to retire now. That kind of argument is going to be seen in the coming 5 to 10 years, and it's going to play havoc in the DC marketplace.
So where do you go from there? Because, and that's, I mean, quite frankly, something I struggle with is you have a plan sponsor community, you have a participant base here that very much likes, let's call it the traditional fare, your U.S. large cap and your kind of Barclays based bond or fixed income options, some type of cash equivalent, some, diversification in small and mid cap, and some growth and value, and some passive and active. And I think everyone is very, very content with that sort of, let's call it standard menu fare. As you get into conversations with employers about, well, hey, we probably need to think a little differently. Hey, we need to expand a little bit. There's definitely some pushback on that we get and that we notice. And I guess just kind of giving our listeners maybe some ammunition here, how would you kind of start that movement from that sort of, again, I'm just gross generalization, kind of the current 60-40 environment to something that resembles a little more of what you think might give better options for performance or appreciation or growth of assets in what could be a very difficult decade that we're coming into?
Well, one of the things that I think is just marvelous is today we have a bigger spread between the asset classes that are priced to give us good forward returns and the asset classes that are too richly priced. Bigger spread than we've seen for most of the last quarter century. We saw a bigger spread perhaps at the peak of the tech bubble, and for sure at the trough of the financial crisis. But that spread is huge. So we're, I think, looking outside of mainstream. I've occasionally at conferences, I'll ask, how many of you in the audience, when you look at your 401k options, scan down the list and ask the question, what on this list has had a really lousy 1, 3, 5, and 10 years? And is it now cheap? And usually there's 2 or 3 hands out of 100 that go up. Now, how many of those are engaged in wishful thinking and how many of them actually do that is an open question. But the vast majority are going to scan down the list and say, what's done great? Okay, I want more of that. Well, that's the past return. It has nothing to do with the future return. In fact, to the extent that it is related to future returns, it's an inverse relationship. So another way to look at things is to ask the question, what has struggled in the last few years? And two, has it struggled because it's gotten cheaper, or has it struggled because the fundamentals have been falling apart? And three, is there a strategy in this area, if it's gotten cheaper, that has demonstrably done well relative to these markets? Those are questions that can lead to superior investments going into the future, where just looking at the past and saying, oh, I'm going to buy this hot strategy that's worked brilliantly the last 5 years, that's a formula for very, very disappointing long-term returns.
No, I like that, and I appreciate you kind of bringing that up, and I think that's a good start of an exercise just to get people thinking a little differently. I guess pivoting you slightly here, one thing that I feel like we've heard as kind of a constant refrain since the pandemic and since the dramatic decline in interest rates is, well, we don't really see much that's going to move interest rates higher in the next several years. Yet here we are in March of 2021, and we've seen I'll call it a pretty big rise in the 10-year. And I guess my question to you is, and I know these weren't your predictions, but I'm just saying I'm sure you've heard and seen the same things I have. Is that sort of rise that we're seeing in interest rates right now, is that kind of within, let's call it, the margin of error of some of these predictions? Or is the interest rate market doing some things that people weren't necessarily anticipating a couple months ago, several months ago, et cetera?
Those who predicted low rates for longer will, of course, say that the rise is within the margin of error. I would say it's pushing boundaries on that. The rise in interest rates is quite simply a function of the fact that a rising cohort of investors is worried about inflation. Now, could this be a deflationary environment as a result of technological innovation, as a result of productivity enhancements during the whole COVID thing? Anything related to manual labor went into a depression, and anything related to technology went into a boom. And so objective measures of productivity soared, median wages soared, supplemented by those checks, of course, and affected by the low wage people going out of work. All right, well, that's redistribution from the working poor to the affluent. It's not something that any of us would want to endorse. But be that as it may, the fear is that, as has happened so often in the past, not so much in the U.S. In the U.S., we've seen it a couple of times in the last 60 years, but not on a large scale. But in international markets, countless times we've seen overspending, spending money that a country or government doesn't have, sowing seeds for renewed inflation that can get terribly out of hand. The marketplace is probably also reacting to Powell's comments, suggesting that 2% inflation isn't a ceiling of the maximum inflation that he'd find acceptable. Rather, he'd be looking for that as the average. Well, trailing 10-year inflation is low enough that for inflation to average 2% over the last 10 years, we'd have to get 6% inflation today. Okay, does that mean that Powell will continue to stimulate until we see 6% inflation? Probably not, but he certainly is not going to panic at 2 or 3, maybe not even at 4. And so if that's the case, then renewed inflation could easily happen. Do I think it's likely? I'm of a mixed mind on that, but I know it's possible. And I know that inflation-sensitive assets, with the obvious exception of TIPS, are cheap. TIPS aren't cheap. The yields are negative. But other inflation-sensitive assets are cheap. And so you have the opportunity to hedge against inflation risk at a price that is likely to deliver a higher return than 60-40. So you're going to be paid by the market to take on protection against the risk that 60/40 doesn't protect you from.
Yeah, and as you've told us in the past, it's best to get your hedges in now versus waiting until you need them. And I butchered that, but hopefully the sentiment was somewhat correct.
That's spot on.
Is some of this attributable to, the new Biden administration and, maybe Janet Yellen in Treasury, or is this just sort of broader market forces that are not really attributable or relevant to, some changing political winds?
Sure. I'm going to frame these comments in a context of acknowledging that I'm a libertarian, which means I favor limited government, I favor human liberty, economic freedom, respect for the Constitution. Neither party in 2020 exhibited any interest in any of the four. Ouch. So I was joking last year that the election in November was going to be massively important because it was going to be a choice between somebody who would run $2 trillion deficits as far as the eye could see and somebody who would run $3 trillion deficits as far as the eye can see. It was a joke, and usually somebody would say, yeah, but which is which? And my response would be exactly. We don't know which is which. So politics has a lot to do with long-term economic growth. No matter which party you're in, if you engage in massive stimulus, you're slowing long-term future growth in favor of looking good this year. That's not helpful. Would there have been massive stimulus if Trump won? Yes. Is there going to be massive stimulus under Biden? Yes. The big difference is probably on the regulatory front. That is to say, Trump was a strong believer in deregulation, and Biden is a strong believer in re-regulation. So that could have a lot to do with long-term future growth, but not necessarily capital markets returns. And the reason for that is actually quite subtle. If you ramp up regulation and slow economic growth, you're also impeding the appetite for new enterprise creation and risk-bearing. A high appetite for new enterprise creation and risk-bearing means a high discount rate, which means lower market prices. So a libertarian approach, a laissez-faire capitalism approach, can actually be great for the economy and lousy for capital markets valuations. The growth is there, but the valuation of that growth is lower, so it kind of cancels. Where a hyper-regulation, suppose AOC was president, hyper-regulation would lead to awful long-term growth, but would make the appetite for new enterprise creation to just fall off a cliff. And if you aren't using your money to start new businesses, what are you doing? You're spending it or investing it. If you're investing it, you're a buyer indifferent to valuation, and valuation indifferent buyers bid up valuations. The discount rate also tumbles, creating higher valuations. So very oddly, and for surprising reasons, the political landscape has shockingly little to do with short-term market performance, except from the vantage point of fiscal and monetary stimulus flowing into the capital markets and providing that temporary boost.
And coming back to the, some of the short-term and the inflation side of things, I mean, is inflation ultimately helpful for us, and is that something that can be viewed as a positive, or is this really just providing a potentially a more massive headwind to producing real returns in some of the more traditional asset classes?
Well, let's remember what the real purpose of money is. It's to exchange goods and services. It's to provide a stable store of value. It's to facilitate spending my time and effort and the money I receive for it for purchases of goods and services created by others today or in the future. Now, viewed in that very, very simple, very basic purpose of money, what could be better than an utterly stable currency, zero inflation? the Byzantine Empire had a currency called the Byzant, which did not change value, had essentially zero inflation. It had booms and busts, but they canceled. It had essentially zero inflation for 660 years. And we fret about whether we can get inflation under control over the next 2 or 3 years. It's crazy. The modern economics profession has morphed from an embrace of Keynesianism in preference over what's called Austrian economics to a complete shunning of Austrian economics. It's hard to get a job if you're not a Keynesian and you want a job in the academic economics profession, to neo-Keynesianism, to MMT, modern monetary theory. And this evolution, I think, is very dangerous. It's gone from Keynes saying you should definitely run deficits during hard times and pay for it with surpluses during good times, to let's run deficits and let's aim for relative balanced budget during the good times, to let's run big deficits during bad times and small deficits during good times, to let's run big deficits during a very powerful economic recovery. Ouch. So I think that's very dangerous because it disregards the negative effects of excessive stimulus. I mean, nobody, not even a strident libertarian, is likely to argue that at the early stages of the COVID lockdown, when nobody knew what we were really dealing with, when nobody knew what the right answer was, when shutting things down seemed to be the correct answer, nobody argues that we shouldn't have been empathetic and taken care of the people most severely impacted. But that view has gone by the wayside. And so the ideal inflation rate is 0. And any suggestion that 2, 3, 4% is healthier is just flat wrong.
And walk me through that one, because I got to admit, Keynesian, neo-Keynesian, all the stuff you just mentioned, that I'm following what you're saying, but those terms aren't ones that I could define. But certainly the statement that inflation at 0 would be the ideal. I've heard from others, and again, I'm not a classically trained economist here, but I've heard from others that that 2 to 3% inflation rate is healthy for the broader markets, for the economy, et cetera. So would love to get, as inflation's sort of the topic du jour, how are some of those assumptions, maybe wrong or incorrect?
Well, again, let's go back to the key definition. What is money? Money is nothing more than a means for me to exchange my time and productivity for your time and productivity, for a grocer's time and productivity, for a dentist's time and productivity. Is simply a means of exchange. And viewed as a means of exchange, both concurrent, spending my time and energy to buy stuff today, and in the future, why on earth is 2% inflation better as a stable store of value than 0% inflation? Now, negative inflation creates problems. Deflation creates problems because of the so-called zero bound, that interest rates can't go below 0. Well, we've proven that's not true. But it's a squishy bound. It's hard to get it much below. You can get interest rates to 10%, 20%, whatever. But to -5, don't think so. -10, forget it. The reason negative deflation is bad is because it forces the real rate to be positive and arguably higher than is healthy. So if you get to -2, -3, -4 deflation, you're going to get to 2, 3, 4% real rates, which quash macroeconomic growth and investment in new enterprises. If you get to +1 or 2 or 3 or 4%, all you're doing is reducing the real value of money that's been saved. It's a stealth wealth tax. plain and simple. And earlier in her career, Yellen acknowledged that it's a stealth wealth tax.
Got it. So we've covered a lot of ground today, and again, always appreciate your thinking around things and kind of calling out some of the current assumptions and kind of getting people out of their sort of present state of thinking about returns and everything. What haven't we talked about, or what would be good to kind of put out there that an employer or someone kind of helping people make decisions about retirement plans in 2021 should be thinking about or considering?
Well, I think the main things would be ones that we've already touched on, and that is, do not encourage people who are trusting you for advice. Do not encourage them to chase past returns. We're in an industry that probably the only major industry in the global macroeconomy that hates a bargain. Imagine if Tiffany's put a banner sign saying post-COVID sales, everything marked up 20%, and people were bashing down the doors trying to get in. And across the street, Cartier has a banner sign, post-COVID sale, everything marked down 20%. And people were saying, oh, something wrong with that product. Get me out of here. That's the way people think about investments. What's up 20% is now 20% more expensive than it used to be. Why would you want to chase that? What's down 20% is 20% cheaper than it used to be. Doesn't mean you automatically buy it, but it does mean you ask the question, did it fall 20% because underlying fundamentals eroded 20% or more? Or did it fall 20% based on speculation that has it at new cheap valuation levels? Value over the last dozen years has underperformed growth by 55 percentage points. Just a huge underperformance. But it's gotten cheaper relative to growth by 67 percentage points. Now, if you have a stock that's down 55% and its PE ratio is down 67%, meaning earnings are up, do you view that as, get me out of here, I can't stand the pain? Or do you view that as, I can't believe it's this cheap, maybe I ought to start averaging in? Do not buy bargains assuming that you're going to pick the turn exactly right, or with an impatience, if the bargain doesn't do well in the coming 3 months, I'm out of here. Buy bargains on a basis of averaging in. And if you do that, you're likely to have wonderful long-term performance. You will enter early. And when you enter early, until the turn happens, you're going to look and feel like an idiot. But the courage to top up and continue averaging in is arguably the best formula for long-term success that an investor could have.
No, good food for thought. And again, especially based on where we are in this current market environment and a lot of what we talked about, I think, again, courage is a good word, because it doesn't take a lot of courage to kind of look back and say, hey, we want more of this stuff that's great. But it does take a lot of courage, especially from, people making decisions about 401k plans where this might not always be their job. It's not always their primary purpose, that they're at a business or that they're involved in the committee. And yeah, it doesn't always feel good. It doesn't always, doesn't always give you maybe a huge sense of confidence to say, yeah, these things that are broken, we want to put some of these in our plan. But I'm with you, and I really appreciate your feedback and thoughts here, that hopefully some of what you shared today will resonate with those that maybe want to think a little differently about where they go from here in what could be a pretty different and challenging decade than the one that we closed out a little while back.
One of the best predictors of long-term returns, ironically, is past long-term returns. What's done well in the last 5 to 10 years rarely does well in the next 5 to 10 years.
Yeah. Well, Rob, you've done well again. Thank you for being here. Thank you for sharing your insights. Always much appreciated. And certainly, as we tackle some stuff again in the future, would love to have you back.
Thank you so much. Greatly appreciate it.
And there you have it. Rob Arnott, Research Affiliates. Never a dull moment. And what I will say is, certainly over the last several conversations we've had, Rob has been very consistent in his belief and passion for diversification and sort of investing outside of the mainstream. So in the grander scheme of things, I think consistency is a good thing. Coming up on the podcast, we have a great conversation about student loans and their impact on retirement savings and a bunch more thoughts from Josh Deutsch at T. Rowe Price. That should be a great episode. And then, as I mentioned in the intro, if you do have ideas on a topic or question or guest that I should pursue that would be helpful to retirement plan sponsors or those who partner with them, send me an email to feedback@401kfridays.com and we will take it from there. Until next time, I hope you make your Friday a 401k Friday. And now for some disclosures. The content in this podcast is provided for educational and discussion purposes only. Investing involves risk, including a potential loss of investment. Lockton does not and cannot guarantee the future performance or specific level of performance, the success of any investment, or success of any strategy. Nothing contained herein may be construed as investment or legal advice.